Daniel here, General Concepts. Wanted to just briefly talk about a life insurance retirement plan. What is a LIRP? A LIRP can be anything from, well, I say anything from, it's usually done with a index universal life policy, but it can also be done with a whole life policy. It's about having permanent life insurance that has maximum cash value. And the difference between those two policies is just how much safety do you want in the growth. Index universal life, you're going to have ups and downs. You do have downside protection. And in some cases, you could have a higher payout. They have to be structured properly, just like the whole life does, in order to control your insurance costs, because you're not doing necessarily this policy for the death benefit. You're doing it because of the cash accumulation. You want that cash accumulation to be on the closer side to the death benefit whenever you go into retirement. That's the simple way of explaining it. But there's a little bit more, for some people, there's a little bit more uncertainty with that, even though you have downside protection, because you won't go below a 0% floor. So there are some assurances, but with whole life, your assurance is that it's always going to grow, every year, uninterrupted, maybe at a lesser rate. But in some cases, you end up winning. It just depends. It depends on the time frame. It depends on the interest crediting rate. Again, they all have their little things. But what the actual plan does, without getting into too many specifics, which I guess I already have, what you actually do is you have this cash accumulation over time. And of course, you pay in your premiums, and you're going to have more money, within the third, fourth, fifth year, and so on, available to you in cash value for that year, more than what you paid in actual premium. So in every year, at least with whole life, let's say, every year that amount goes up. It's never the same or less. It always goes up every year. So this year you paid $10,000, and you're in let's just say year 4 or 5, let's just say 5. Maybe you have $10,200 available to you. In the following year, it's going to be $10,400 or $10,500. It could be very well be more than that, because I can tell you in the 11th or 12th year in my policies, on one of them, year 13 or 14, they have all since about year 11 or 12 produced more than 2 times what I put in. So if I put in $10,000, I might have had $21,000 or $22,000 available to me in a policy. But I have different size policies. I have multiple ones. I'm putting in a lot. I'm utilizing it for the infinite banking. But you're able to do that, and you're also, as long as you're paying the money back as you're using it, and you're basically just causing a reciprocal flow of money in a lot of different ways, you can still use it for retirement. So going into retirement, one, if you're getting that kind of return, you're going to come up with the money to pay that in and have that money available to you, right? By the time I retire, I'll probably be getting 4x on what I'm paying in. So there's a lot of different aspects to that. But with that being said, that creates an income. That's one strategy. The other way is it's overall accumulation. That's what you would do, say, in IUL, or you could be doing it with whole life, and you're just socking away money and it's growing. You're not really borrowing it. You're not really doing any of that. And you're waiting until the end. And then what happens is you take your cost basis. Well, there's 2 different strategies. It's probably most efficient to take your cost basis up, or take your withdrawals up to your cost basis, meaning that the amount that you've paid in, say if you've paid in $500,000, you take up to that $500,000. And of course it's tax free because it's a return of your original capital, of your original money you put in. And then after that, you take loans. And depending on the kind of account it is, will depend on, or I say account, the type of policy it is, and the company will depend on the interest rate. So there's one whole life company that they come down after 20 years of being in force, or age 60, it goes down to 3% on your loans. But on the flip side, many of your index universal life, they have a 3 or 4% in general, what's called an indexed loan, which means that it still participates in the because you're borrowing against it, of course. So you're borrowing against the actual policy. It's still going to participate in the crediting. So you're going to get growth at the same time that you have this loan outstanding. And then ideally what's happening is, of course, you're getting credited 6%, 7%, whatever it is, and your interest rate is 3% on your loans. So in general, these can work very well, and some people use it to complement other things, maybe their IRA, their Roth, or 401ks. I know I have clients that don't use any of that other stuff. They just use their life policies because they like the tax-free income on the back end. That's the difference. You have to calculate whenever you have your regular retirement accounts. You have to calculate, what is it actually going to cost you on the back end? What are the taxes? What are the fees while it's in force? So if you compare the two, a lot of times they come out to being close to the same. Sometimes they're exactly the same. Sometimes they're not. I mean, it just depends on the market, really. But you've also got to look at the sequence of returns as to how long it takes you to recover from a dip. How big is the dip in the market? Where you don't have that with index universal life, because you're not going to take that loss with the dip, where you will in a regular retirement account. It also depends on where the money's allocated. So to be fair, it depends on what you're in. And even then, it's hard to really compare the two, because one is an investment, one is technically not an investment. Even though you may have a growth, vehicle that it has an internal rate of return and it is protected, and it's, you have that tax-free growth, it's after-tax dollars. You really, because it's an insurance contract, so there are some assurances where in an IRA, you don't really have those assurances, obviously, but you may have a bigger upside. So I think it's to each their own. Like I say, in many cases, people do both. People will do their 401k and do up to the matching. So they'll match up to, a certain percentage or a certain amount, whatever the case may be. They'll do the matching, and then they won't put any more money in there. I have clients that do that all the time. They do up to the matching, like maximum, and then the rest of their money goes into their life policies or their life insurance retirement plans. Or if they're doing infinite banking, or maybe it's doubling as both. That's pretty much the general idea of it. If you have more questions, you want to find out more about it, there's going to be some links down in the description to schedule onto my calendar. Have a great day. Please like, subscribe, click that little bell, and I will catch you on the next one.